Hey, welcome back to The Dive. Today joining us on the show is Dean Nawata. But before we begin, you might want to smash that subscribe button. Hey Dean,
Okay.
welcome to The Dive.
Hey, thanks very much, Cassandra.
Yeah, thank you for joining us. Okay, so Dean, as a business developer, how do you pinpoint growth drivers for a company you're working with?
Um, yeah, really, this is sort of a very important part of looking, especially in the junior capital markets. The growth driver, I think it's really two parts. Number one is the underlying growth drivers in the commodity that you're looking at. Whether it be gold or oil or uranium. Um, So, you kind of have to look for that underlying growth factor. So, as an analogy, if you're running a really good business like a Blockbuster renting VHS videos, is there, good growth ahead of it in the actual VHS business? Probably not, right? Um, and then the other is the way that the companies are managed or run. So whilst you could have a good management team running Blockbuster, the underlying commodity doesn't have that much growth towards it. Now, if, for example, if you were to have a Starbucks coffee, is it a huge hockey stick growth in coffee? Probably not, but is it very sustainable? Yes, right? So therefore, the growth driver then for the company's got to be the management. How do they manage that? How do they run that business? Do you take your Starbucks coffee and run one very profitable um, store, or do you take the chance, raise a bunch of money, and uh, open 250 stores on the best street corners across North America? There's that's all done by management. That wasn't like coffee went to the moon or anything like that. That was actually driven by management accelerating growth. And in the stock market, that is where the stock prices and increases or decreases in stock prices come from. Largely is the growth pattern, the future growth pattern. Where can the company go next year, the year after, in the future? So, bottom line, what do I pinpoint for growth drivers? Those are the two things. Number one, the underlying commodity or item or business or industry. And number two, how the management runs the business on an accelerated growth pattern.
Okay, perfect. So let's talk about macro. The Federal Reserve has maintained its stance about inflation. Do you see this as a concern as the economy starts to pick back up? Or do you think they are prepared to raise rates quicker than they are communicating?
Oh, Cassandra, that's sort of that's a tough question. I'm definitely not an economist by any stretch of the imagination, but if you follow me on Twitter, I follow a number of people that are much better at it than myself. But having said that, you know, um, I'd have to say from an everyday guy and that's living here today, um, you got to think that there's inflation happening. Um, just have a look at housing prices, rental prices for living. Um, I saw somewhere food costs are, double digit increases just over the past year and a half. Look at fuel. I don't know if it's $5 or $6 a gallon in the States, but it's a dollar 70 something per liter up here in Canada. We haven't had prices that high. Um, and the bottom line is, at the end of the day, inflation, whether or not, it's the dog that wags the tail, is it the Fed that controls interest rates, and are they controlling inflation or trying to control it? I don't know. Bottom line is, for us regular folk, every day everything costs more money, right? So another way to look at it is your dollar, whether it's a US dollar or a Canadian dollar, um, buys you less. In other words, every day that you live, you have to either do with less, right? Or try and make more money. So part of your question was, of course, as we come out of this pandemic, is that going to have an effect on things? Sure, it is. And is it going to be deflationary or inflationary? Well, um, with the advent of some of the technologies or some of the high technology that's coming forward, like today we're on Zoom instead of me being in your studio somewhere, which would cost me airfare, hotel, and time. Um, that's somewhat deflationary, but by the same token, that is also taking away uh, from the airline business, the hotel business, the coffee shop underneath your office building and your studio, etc. So, on balance, yeah, I think that inflation is here. Um, the Fed had said that it's transitory. They thought that it was transitory. The last that I heard, a couple of days ago, they seemed to be backing off a little bit and saying that it may actually be a little more permanent or a little more sticky than we thought, which I believe would be true. But you have to remember as well, through this pandemic, um, the Federal Reserve in the United States and elsewhere around the world, central banks around the world, have printed, trillions and trillions and trillions of dollars worth of paper currency, which has not only has the potential, the obvious potential of being inflationary. Um, it's all done on leverage, so each of those countries or each of those banks is going to have to pay that money back somehow, some way. Now, are high interest rates good for that? No. So I think things will bounce around, but at the end of the day, I believe that powers that be would love to try and keep interest rates as low as possible for some time to come.
Okay, so Dean, you mentioned you have a history in junior mining. What are the high level factors that attract you towards a junior mining project?
Somewhat related to your first question there, Cassandra. The way I look at things as an investor, especially in the junior markets, venture capital or mining or exploration, is really three things. Number one is people. Number two is the asset, and number three is the company structure. The reason for that is um, those assets, whether it be a potential gold deposit or an oil pool, um, those geological things have been sitting there for millions and millions and millions of years. They're not moving, they're under the ground there, just yet to be discovered. So the reason I put people first is it's really only people, a person, or a group of people that can actually come and find that asset and commercialize that asset, right?
Mm-hmm.
And so that involves whether it be management that has to raise money, tell a story, a dream story on looking for a lost gold deposit somewhere, um, to geologists and geophysicists, et cetera, science to figure out what would give you the best chance to find that gold that's been sitting there for millions and millions of years. That's why people. Then the structure of the company, um, that's kind of like the vehicle, like the car that you use to get there. Um, you want to make sure, if you're, an explorer looking to find the west coast of Canada in a canoe, and no one has ever been there before, you want to make sure that you have your canoe in the best shape possible. You've got a couple of extra oars. You've got extra food and repair kits for the boat, because without the boat, you're not going to get there either, right? So those are kind of the three main things that I look at, but they all fall under the umbrella of people. So that's management and the team.
Okay, so let's talk about helium now. What can you tell us
Mhm.
about the overall helium market?
Yeah. So full disclosure, I work with a company called Royal Helium. They are exploring and developing helium deposits in Saskatchewan, which is kind of a unique place. But the overall helium market is interesting in the sense that number one, helium is used for many things, but the important factors are that the helium is not substitutable currently. Like there's um, nothing that you can use that has its properties and does what it does. It's very unique. The other is that it's non-renewable, and you can't manufacture it. It's a funny element on the periodic table. It's the only element um, that will not bind or react with any other element on the periodic table. So it's got a very serious uh, uh, set of properties that no other element on the planet has. So uh, that's part of the helium market. I know that it's become a little bit more mm, not popular, but people are starting to look at helium and helium plays over the past year and a half. I think we've got, I don't know, three or four junior companies that have come to the fore. I would, for example, with Royal Helium, I think we were really the first public helium play out there, but we're really only at 2 or 3 years old. So um, um, yeah, we'll sort of see what happens with that type of play, and then bringing it back again to what we were talking a little bit about right at the outset. As a developer, what do we look for? So one of the things with helium is you have to look at the underlying commodity or the element. So that would be helium. What are the growth drivers that are involved in that? And when we looked at this industry, we could see that there's a tremendous amount of future growth that's coming right now. The big growth drivers for helium are in um, the high tech business, so manufacturing. So it's used extensively for the manufacturing of semiconductors like computer chips, LCD screens, fiber optic cable, that kind of thing. Um, it's also used extensively for rocket engines as a ballast. Um, these are all things that are reasonably new, not decades, but reasonably new and growing. So big growth drivers involved in there. Of course, along with that is a limited supply. So therefore, looking for helium is not a bad thing. As I mentioned then, with helium, what you also have to look for then is the management. Like, how are you going to run your business? Are you going to um, have one helium well that can be very, very profitable for one person? Or is the company able to accelerate growth and become like a world leader in producing helium? One of the things that people have to understand about helium is it's kind of interesting because where it is formed, it's formed in what's called the Precambrian basement, deep below the Earth's surface. In Saskatchewan, that's about 2,600 meters deep. So below the hydrocarbon levels, so below the Jurassic period and the Mississippi where the dinosaurs lived, and that's where all the hydrocarbons, oil and gases. So helium is actually formed below that. And the way it is formed is the natural decay of uranium and thorium. So it's like a uranium-238 breaks down and spins off one molecule of helium, becomes uranium-237, I suppose, something along those lines. So the reason I bring that up is from an exploration and production point of view, is very much like oil and gas in the sense that you drill a well fairly deep, straight down, and what you're looking for is a trap or a pocket deep under the ground before the oil and gas zones, and poke a hole into it, and the gas comes up the hole, right? So you're for almost no additional cost, no additional cost, you're actually producing the commodity that you want to sell to somebody, put it in a tank and sell it. I mean, there's obviously more to it than that. You have to separate the gas from the helium from nitrogen. Some wells have CO2 in it, and you separate it out. And there's some processing involved, but not like a gold mine where you might have to dig a hole that's 5 football fields long and and CN tower deep or something like that. So it's kind of different there. So kind of
It's great.
long-winded, but it's an interesting market for sure.
Yeah, definitely. So it's kind of like drilling, just like any other drilling, and then afterwards is when you separate it.
Correct. Like I say, it's a lot more like it's almost identical to oil and gas in the sense that you drill a well, it's just a straight hole. Production casing might be 5 or 7 inches in diameter, but it's 2 kilometers deep, over 2 kilometers deep. It's lined with steel tube. You just drill a hole and you put steel tubing down to case it in to the zone that if you poke into a pool at the bottom, and you can open it up with perforating the casing, and like I say, the gas comes straight out of the hole, which is different than exploring for copper, nickel, zinc, gold, or hard rock mineral exploration, where you would drill a hole, you might find gold, 4 or 5 grams per ton, extrapolate a hole this big, but definitely you can't produce it. You'd have to drill hundreds of holes to outline a deposit underneath the earth, and then after that you have to figure out how can dig all that out and then separate it. So it's a much larger process.
Okay, interesting. Okay, so as you mentioned, one of your roles is with Royal Helium. They hold more than 400,000 hectares of prospective helium land across Saskatchewan. Can you speak to the overall strategy for Royal Helium and where this is going over the next 5 years?
Sure. Again, this speaks to one of your very first questions, and that is, how can this company accelerate its growth? So back to the analogy of a Starbucks, a single helium well could very well be very economic, like a single Starbucks store would be very economic for a coffee shop. But in our case, because the supply of helium is dwindling and very limited worldwide, and the demand and the growth drivers are very strong, in a junior company, what Royal Helium is looking at doing is accelerating its growth. So going from one well to hopefully over the next couple of few years, hundreds of wells. And uh, there's a couple of things that you need for that. Number one is obviously you need lots of land if you're going to try and find hundreds of deposits in a certain area. So, as you mentioned, 400,000 hectares of land in Saskatchewan. Just to give you an idea, that is over 1 million acres, 1 million acres of helium lease land in Saskatchewan. So it's very large. Second largest helium land holding in North America is within Royal Helium. So back to the analogy, then that sort of um, back to Starbucks. If you started with the first Starbucks store in Pike Place Market in Seattle, and you had the rights to downtown Seattle, I mean that's something great. Maybe you could have 2 or 3 or 4 Starbucks if you had the rights to that land. But what they did is they went to the market, raised millions and millions of dollars, but they captured through real estate transactions uh, the 1 or 2 best corners in each major city across North America, Vancouver included, um, and were able to open up, whatever it is, hundreds of Starbucks store, not quite simultaneously, but it rolled out very quickly, right? In a similar sense, because each of these helium wells are very profitable on their own, and what we call in the oil patch, it's called quick payback. In other words, the the real cost to bringing a helium well online is the drilling cost. In our case, it's about $1.5 million, because once you finish drilling it, casing it, testing it, etc., um, uh, from there on, there's not a lot of operational or capital cost. You don't have to dig a big hole, or there's a valve at the top of the ground, right? So at current prices of what you could sell helium for, you would get your $1.5 million back in less than a year, like 5 or 6 months. But these wells last steady state about 5 years in Saskatchewan, longer term about 10 years, because it starts petering out, obviously, as the helium depletes from that particular pool. But they generally last about 10 years. So, um, within 5 or 6 months, you got your money back. Um, you just keep the valve on, and you continue to make cash flow. So from that cash flow, then, almost within several months, you could go drill another well, right? So,
Mhm.
and then you'd have 2 wells running, and they're both lasting 5 or 10 years. So every few months, like, the cash flow would be able to get another 2 wells. So it exponentially uh, grows, right? So that's the main strategy, I think, with Royal Helium is we got pretty lucky. We drilled 3 wells earlier this year. Those 3 wells hit. Um, you can't expect to hit every single time, but in our neck of the woods, if you can, 80% is normal. So 8 out of 10 wells should hit, sort of thing. Um, so the strategy is this: we, rather than just keep those 3 wells, which we'll put onto production and sell, hopefully before the end of this year, rather than just use that cash flow to drill more wells or grow organically. Again, the
Mhm.
Starbucks analogy, we raised about $17 million, and this year, so from this point to the end of the year, we'll be drilling 7 more wells. So the idea would be to have 10 wells, all cash flowing, and from that standpoint, or from that point on, that exponential growth is
Mhm.
is that much greater. So instead of starting with 2 or 3 and growing with cash flow, you start with 10, and that growth is just that much greater.
Amazing.
So that's the main strategy behind Royal Helium. Saskatchewan, why Saskatchewan, which is a little bit different than the rest of the world, which is why we focused and gathered 1 million acres of helium land there, is so far Saskatchewan is one of the few places on the planet that actually has produced from the 1960s and currently produces helium as an inert gas, so no hydrocarbons. It's actually captured or found below the oil and gas zones. So before the helium sort of percolates or migrates up to the oil and gas zones, the rest of the world, Qatar, Russia, the United States, helium is produced as a byproduct of natural gas production. So lower concentrations, and obviously you have to produce the natural gas and process the natural gas in some form or fashion and separate the helium from it. So not that this was on purpose, but it does actually lend to some of the newer environmental standards. So sort of a ESG type of play where what is being produced is largely nitrogen and helium, both of which are inert gases and both of which are environmentally friendly. You could literally vent nitrogen into the atmosphere. Our breathing atmosphere here is some 78% nitrogen. So there are no deleterious elements. Obviously, with natural gas like methane, propane, butane, all of the burnable natural gases, you can't just vent that into the air. You have to either process it and use it, whereby when you do actually use it in your barbecue or in your car, um, obviously you're producing carbon, right? So there's got to be carbon offsets as well. So the type of play, the plays that we have in Saskatchewan, again, no hydrocarbon production at all. So it's just all inert gas and takes very little energy to do.
Interesting. Okay, so let's shift to gold. Our audience is generally small cap focused. What kind of junior gold companies do you think offer the most attractive risk reward profiles at this stage of the gold market?
Yeah, well, myself as well as I guess your audience, I do focus more on the junior gold aspects of things and risk reward wise, I think it all boils back to that accelerated growth pattern that I was talking about. Now, exploration companies are a little bit different than cash flow companies. So the helium or oil and gas or venture capital or Starbucks is more of a cash flow type of situation. Whereas the growth pattern with an exploration company like gold, what you're looking at there is discovery. So um, that accelerated growth is basically an accelerated um, exploration program. So what I would be looking for there are companies that are well funded. So in other words, you have enough money, you have raised enough money. And remember, most of these companies, the helium company as well, or an oil and gas company, they don't make money right away, but those cash flow companies eventually do. And then that's the important part. What do you do with the cash flow? Like you find more helium or find more oil, sell more oil, you accelerate that growth. With an exploration company, maybe you just have a big, huge chunk of land that may be prospective to have gold hiding down under the ground. The only way you're going to find it is have, again, the right geologists, the right technology, the right people to raise the money, and the plan to poke a lot of holes and most efficiently see if you can come up with the discovery. Once you make a discovery, I think most junior companies know what to do. They can optimize a little bit further because they kind of know where that, well, they've got a clue of where that gold might be, right? After their discovery hole. And then it's that accelerated growth. So, what's the most attractive risk reward then? I think what you have to do is reduce the risk at the drill bit as much as possible. Um, Again, so you're kind of drilling blind, it's somewhere under the ground. How do you reduce that risk as much as possible? Number one is you get good, experienced, qualified people in that area that area or know that type of deposit or that type of ground. Uh, you have to pick the right people. And then through those people and technology, whether it's geophysics or soil sampling or testing or what have you, and drilling holes, um, um, yeah, you try and reduce that risk somewhat as well, and try and limit the risk in the stock to what the drill bit finds, right? So you want the right person on aiming that drill, basically. So that's what I would
Definitely.
look for.
All right. So do you think it's a good time to buy junior gold stocks, or should investors be waiting for majors to catch a bid?
Um, I personally think, I mean, at the end of the day, the gold market is very cyclical, and uh, gold has actually done very well just in the past decade or so. It feels like to all of us that it's been waning a little bit for the last 6 or 8 months. Um, but over the course of the last 30 years or 20 years, I mean, it's the gold has gone up substantially. So, but one of the factors that comes into play here is, especially with a gold junior, because they normally don't make money. They have to go out and get investors that are willing to bet on them and their team to find a brand new deposit. Um, if the interest isn't there, so in other words, if people are more betters, investors, people that bet on the junior stock market, if they if there's something like a Bitcoin or something else that can give them a quicker, faster return, they'd rather do that than something like gold. So it's very dependent on interest as well. Uh, what I could say is then, as opposed to the senior gold companies, which are run now more like businesses because they already have some gold deposits or gold resources in the ground, and it's more of a business. How much does it cost for them to dig it out and process it, and what's the margin once they sell it at $2,000 or whatever an ounce? Does it cost them uh, $1,500? Then yay, they make money. If it costs them $2,000 to produce it, then no, that's not too good either, right? So they're quite separate businesses. So, what I would say is, you generally, or myself, you'd want to be ahead of the curve. So rather than buy junior gold stocks when everybody and their dog wants to invest in that, which pushes the price higher, right? It's all speculation. Um,
Mhm.
you look at buying when the fundamentals are good, but the interest level or the price is lower. And I think that's where we're at right now. If you look at the JDXJ, which is kind of a basket of junior miners, or
Mhm.
the JX, the Vancouver, the TSX Venture Exchange Index, we're certainly a lot lower than we are higher. Um, the fundamentals behind why this could play out well, I think that not only that the price of gold is a lot higher than lower, and I think poised to go higher at some point. Um, the seniors themselves are starting to run lower on their resources in the ground or their reserves, right? Because it's a depleting asset for all of the majors, like even the biggest ones, the 2 or 3 or 5 big gold deposits that they have. Every ounce of gold that they produce is gone, and so those assets are soon are depleting, which means that we need more juniors out there poking around, and it's highly speculative. It's very risky, but that's the only way you can find new deposits, new resources, new reserves for those major companies to make a business out of extracting it. So is now the time? I certainly think so.
Okay, great. Okay, so the last question I have here, where do you see the price of gold at the end of the year, and what needs to happen to drive it higher?
Okay, the way I look at the actual price of gold itself is that since it decoupled from any sort of standard, it has risen over time with little bumps and blips along the way. Bigger blips up when there's been financial crises or other things like that. But don't forget, even in 2020, early 2020, when the pandemic started and we had we had a crash in the stock market, the gold went down as well. So it will go with everything else as well. But you know, I so personally, rather than have target rates based on any sort of timing or fundamental valuation metrics, I would suggest just by looking at and guessing at the fact that it's generally going to be going up. Um, and there's a few unknown factors that drive it even faster and higher, meaning inflation. What is the Fed going to end up doing? What is the result of the trillions and trillions of dollars that the central banks around the world have printed? What is going to happen? Uh, I don't think US $2,400 gold is out of the question. It seems all within reason. I don't see any reason it shouldn't be there. So an exact number and exact time, I would leave up to some of the more professional macroeconomics guys out there. But yeah, I think 2,400 is a good number. Which, by the way, for the Canadian explorers, that's $3,000 Canadian.
Mhm. All right. Well, thank you so much for joining us on the show today, Dean.
Hey, thanks very much, Cassandra.
Thanks so much for tuning in today. We'll be back again tomorrow with more small cap news coverage, so you might want to hit that notification bell.